Hello, everyone, and welcome to another edition of the More Than Market series. My name is John Bay, Senior Vice President and Chief Investment Officer at NEI Investments and Avisa Wealth. No question that the headwinds for the global economy have been increasing, with more persistent inflation, more aggressive central banks, a war in Ukraine, as well as a COVID situation in China. So how can investors prepare themselves for what's to come? Today, I'd like to share some thoughts in regards to the market outlook over the short-term and longer-term time period, and where we think there might be opportunities to outperform. Last week, it was a tough week on the inflation front. On Monday, Monday, April 18th, we had inflation readings for the United States where the headline inflation rate hit 8.5%. That was the highest reading since 1981. In Canada, on Wednesday, we came out with our inflation on Wednesday, April 20th at 6.7%, the highest since 1991. So as inflationary pressures continue to rise, there is a realization at the central bank that their rates at 1% and inflation north of 6%, that the central bankers are increasingly behind the curve and need to get to at least a neutral rate, which the Bank of Canada pegs at between 2 and 3% as fast as possible. And so when we heard the central bank chief speak last week in Canada, Tiff McCallum said that he wouldn't rule out a 75 basis points move at the next meeting in June. In the US, Jeremy Powell said that he too wouldn't, that fighting inflation was his top priority, and he wouldn't rule out 50 basis point moves at the next two meetings. And so while we are hopeful that that interest rates, both on the 2-year and the 10-year side, are near peaking, we actually need to start to see evidence that the inflationary pressures are slowing down. And right now, we're just not seeing any signs of that. The war in Ukraine, for instance, is only exacerbating those inflationary pressures, and we're only just starting to see those pressures work their way into the numbers. But importantly, having said all that, we do not think a recession is our base case scenario, even with more aggressive central bank rates. As I said, for now, we are still below neutral rates, and we do not expect them to go above neutral until early 2023. Additionally, we're seeing that consumer and corporate balance sheets are very strong. Employment is still very strong. We still haven't seen a full recovery in the services segment, and earnings on the corporate side are still positive and rising. Having said all that, it's not uncommon for stocks to go sideways for both over the short term and longer term periods. For instance, I think we're actually in that scenario. The last time that we saw the S&P 500 go sideways for a long period of time was actually from the period 2000 to 2012. And again, you see these for over the last 100 years. The S&P goes sideways, then shoot up, then goes sideways again, and then shoot up again. And I think that with all of the headwinds that we're facing now, we may be in another one of those environments. Just to take a step back on a longer term viewpoint, over the last 40 years, we've been an incredibly strong macro environment. Inflation over the last 40 years have been downward sloping, and globalization has been upward sloping in terms of one of the key reasons why we've seen inflation go down is that we've been able to export 100% of our manufacturing capabilities to cheaper jurisdictions. As a result of falling inflation, interest rates have been at a downward slope for the last 40 years, and geopolitical trends have been very, very stable. But on a go-forward basis, we think that these trends are going to change. Inflation will go from downward sloping to upward sloping. Globalization has run its course. Interest rates, again, downward sloping to sideways to up. And geopolitical going from more stable to less stable. And so, with all of those trends, again, like I said, I don't think it will be uncommon or to expect a sideways moving market. And so then, so that's the bad news. The good news is we still think that there's opportunity for investors to grow wealth, and even in this type of environment. But the critical part of this is that in order to outperform in a sideways moving markets, you need to start to focus on active management and portfolio managers that are able to pick companies that are able to grow at above industry growth rates. In order to do that, again, there's some certain thematics that we think are really important for investors to keep their eye on. One such thematic is global climate change. We certainly believe that over the next 10, 20, 30 years, the global economy is going to decarbonize as they start to focus on their Paris commitments and trying to reduce the most severe aspects of climate change on our global environment, economy, as well. And so with that, NEI is very proud to have launched the NEI Clean Infrastructure Fund that will take advantage of many of those trends. Again, by focusing on a very low carbon footprint utilities, we think that as the global economy needs to increasingly electrify to reduce our carbon footprint, we think that investing in utilities with a footprint that is materially below industry carbon footprints will be best positioned to take advantage of that trend. It's also a very defensive strategy with high dividend and growing dividend streams over the next 3 to 5 years, as well as it's a strong impact where, again, we will continue to measure the positive impact that the strategy has on the environment. And so with that, we thank you for tuning in. We hope that you found today's discussion helpful. Please watch out for next week's edition of the More Than Market Call. And as always, please reach out to your NEI representative with any questions that you may have. Thank you, everyone, and stay safe.